Sonlin and Herwig Konings are founding partners of Security Token Group. All opinions expressed by them or guests on this podcast are solely their opinions and do not represent the views of Security Token Group or its subsidiaries. You should not take any opinion expressed on the show as a specific inducement to make a particular investment or follow any investment strategy. This podcast is for informational purposes only.
Hello and welcome to the Security Token Show. I'm your host, Kyle Sonlin, and with me is my co-host and business partner, Herwig Konings. And we're coming to you from our studio here in sunny Miami, Florida. And today we're going to give you the latest security token news, tell you about the latest security token offerings and updates, and give you a breakdown of last week's trading activity in the secondary market.
That's right. And then we finish off the show with our weekly main topic discussion, which this week is how blockchain has become front and center for Wall Street thanks to the stock market frenzy that happened with GameStop. But of course, we can't get started without first doing our Company of the Week awards, where we highlight two companies for making the biggest moves in the industry last week. So who's your pick this week, Kyle, for episode 79?
My company of the week for this week is actually for the second time is Axoni. The firm has raised an additional $31 million from German bank Deutsche Bank, Intel Capital, Swiss bank UBS, and some existing investors, including Citi, Goldman Sachs, JP Morgan, Wells Fargo, and a whole host of other banks around the world. And this investment is classified as a Series B add-on, with the round initially announced actually in August of 2018, which is kind of crazy to me. But it does bring the total amount invested for the firm up to $90 million from these institutional players. And so Henrik Johnson, who is Deutsche Bank's co-head of global capital markets, commented on the fundraise saying, quote, "Across the banks, the potential reduction in operational risk is certainly in the hundreds of millions, if not billions of dollars. And Axoni has added support for 4 asset classes, including bond issuance through the Deutsche Bank platform Direct Books, as well as 3 other networks that aren't yet public." And so the firm claims to have 20 clients now, which include buy-side and sell-side firms, infrastructure providers, and tech companies in the US, Europe, and Asia. So, for creating an incredibly institutional platform, again, that's focused on debt and settlement of debt that even the banks themselves see as a potential $1 billion+ savings opportunity for them, and bringing all those banks together to improve and innovate in capital markets, which is completely manual in a lot of cases, but is significantly larger in terms of debt than the equities market. That's the reason that Axoni wins my company of the week. They're doing awesome work in the blockchain space, and congrats for raising more money.
Oh yeah, that's a phenomenal choice, Kyle. I think I was reading that they were just shy of reaching unicorn status with this round, which was kind of crazy to think about for a blockchain company in this space, and well-deserved, and clearly traditional finance is putting their money where their mouth is here.
Absolutely. Very, very exciting. How about you, Herwig?
Well, for my company of the week, I'm sure everyone has been reading about this or heard about it, and it's familiar with the situation to some degree. But my company of the week is only what I consume is going to be America's next trillion-dollar company based on all this market demand. And that's, of course, none other than GameStop, which saw its market cap skyrocket from a little over $1 billion in December to now recently above $15 billion. And that's all because outside investor forces are fighting a now historical short squeeze on the company, where one group is betting the company will fail while the other group makes them try to lose their bet to buying up the price and increasing its value. So with the value increasing, the investors lose their bet, and now they have to pay up in the form of buying more stock, which makes the group betting on the company realize even more gains as the price of the stock continues upward from the losers paying out. And what's crazy about this is that this is the so-called retail investor base, the Joe Schmoes and millennials and Reddit subscribers of the world that took on the hedge fund elite betting against GameStop. And so at one point, the battle got so big that there was more synthetic short position than the company itself was worth. So what does any of this have to do with security tokens, you ask? Well, the resulting battle took place on an infrastructure developed in the 70s, which can take between 2 and 3 days to settle trades on. As a result, at one point in time, the brokerage platform of choice by the retail investor group Robinhood couldn't afford to even settle trades in such large volumes and sizes, and therefore paused buying as an option. Needless to say, all of this has caused media uproar and Wall Street uproar like no other, and newly famous legendary investor Chamath Palihapitiya, who goes on to claim his fame from starting off the SPAC frenzy in the world, said in a podcast episode that this GameStop scenario has illustrated the, quote, first obvious use case for a blockchain, because it could prevent things like overloaded brokerage platforms or preventing short positions to develop into something larger than the company itself. And that's a huge deal because people, especially Wall Street, they're paying attention to Chamath right now, and he just endorsed blockchain for capital markets, aka security tokens. And we're going to dive into all of this later in the main topic discussion at the end of the show, where we'll really provide some context as to how the blockchain prevents a lot of the problems that occurred during the GameStop frenzy over the last week. But for now, great job, GameStop. No one really knows what you did other than try to compete as a software retailer for video games and seemingly look like the next Blockbuster. But suddenly now you're the block winner. So awesome play of events, GME. I'm rooting for you, even if I don't have any personal exposure to your stock. After all, I do like you because that's where I managed to get my PlayStation 5, Kyle, GameStop.
Yeah, what a better way there's no better way really to demonstrate the benefits of blockchain technology than to watch the traditional capital market infrastructure fail in a lot of ways. And so, as you said, GameStop was maybe right place, right time on that front, but I think you're going to really enjoy the main topic discussion. All you listeners, you're going to hear even more about how all this stuff can be approved. And congrats to GameStop, I guess, for winning.
So with that, let's get into the security token news. And of course, before I do, I want you all to know that, the articles we cover on this show, they're sourced from stomarket.com/news. And they're also available for reference in the about description of the podcast itself. Or you can always go to the Security Token Show Medium blog whenever you want if you want to go check out these articles for yourself. Now, starting off our news reel this week is Switzerland, which sees major rule changes go into effect this month, as well as actually sometime later in August this year. So in September of 2020, Swiss Parliament approved the groundbreaking laws that allow distributed ledgers to host and track securities, as opposed to just relying on a digital registry or paper share certificate system. So this gives security tokens their legal entitlement as a representation of ownership of securities, and the law also further brings in changes by the end of the summer, including a new license for security token marketplaces and clearer rules for custodians. So all in all, a major step forward and now officially soon in effect. So just last week, we saw Luxembourg announce a similar initiative, and Germany and France and other countries around the world have also made similar moves in an effort to formalize and bolster their respective security token industries. So great job. And over in the UK, the Treasury Department released a consultation paper on the regulatory oversight for stablecoins and crypto assets. So the consultation sets out the three objectives the government proposes for approaching regulation of what they call crypto assets: financial stability and market integrity as 1, consumer protection as 2, and promoting competition and innovation as 3. Now, these are accompanied by 3 principles, ensuring that the regulatory approach is proportionate to its focus on risks and opportunities, it's agile, and it applies the same risk and same regulatory outcome approach. So these would be a phased 2-step process for the introduction of regulation. First, the government has proposed that a regime would be introduced for stable tokens, as they say, used for payment covering their issuers and firms that provide services related to them to consumers. In the second phase, the government would consider whether to bring a broader set of crypto asset market actions or tokens into that authorized regime. Now, such actors could include decentralized finance platforms, they say, and the activities connected with them, and the currently unregulated exchange tokens being used in the retail market for speculative investment. So again, this tells us that we can expect the UK's regulators to develop a crypto asset framework for stablecoins and potentially other crypto assets sometime within the year. And finally, we've been trying to keep you loyal listeners updated on a major case that could have ramifications for the crypto and security token industry here in the United States. I'm referring to the biggest case of the year for the SEC with crypto and their lawsuit, of course, against Ripple and its founders for selling over $1 billion worth of unregistered securities. And the firm has officially clapped back with a response. So Andrew Suresny, outside counsel to Ripple from law firm Debevoise and Plimpton, states, quote, "The SEC's case is unprecedented and ill-conceived. The SEC has ignored XRP's clear status as a virtual currency, contradicting not only the findings of other U.S. regulatory agencies, but also international regulatory regimes. So over the last 8 years, the XRP market independent of Ripple's activities, had grown to a massive scale, trading on over 200 exchanges worldwide. The SEC is now stretching the concept of an investment contract beyond its breaking point. We look forward to presenting our case in court, end quote. So yes, it seems like Ripple isn't doing anything unexpected here. They're going to go double down on the fact that XRP is not a security, citing, of course, other agencies and their thoughts on it. But I will say, outside international regulators' opinions don't matter all too much here. This is a court case about Ripple and the Howey test, and the SEC will make its case that the company violated the laws. And as we can see, the legal battle will result around the term investment contract. So this high-profile case could create a precedent or new outcome for the industry. And therefore, we're going to continue to keep you updated on the show on this likely to be months or maybe even years-long battle with the SEC for the company. So meanwhile, their coin, XRP, has suffered over 50% losses of value on the crypto markets. And moving into company announcements, Japanese investment bank SBI has been known as an active proponent for security tokens for some time now, previously hinting at plans to launch a dedicated security token exchange in the region. And now they have revealed more information about their plans, which involve launching in 2022 with partner SMFG, that's Sumitomo Mitsui Finance Group. And the new exchange will be dubbed the Osaka Digital Exchange, which will be owned 60% by SBI and 40% by SMFG, kind of indicating, I guess, that SBI will retain the lead responsibility in the exchange here. And that's a big deal because few countries are developing exchanges built on blockchain technology and also supporting security tokens with government support. So major news for SBI and Japan to start off here. And over in Singapore, we saw the SDAX, that's the Digi Assets Exchange of Singapore, officially receive MAS approval to launch. So they've received what is called an AIP, or an approval in principle, which presumably means they can go live, assuming that they probably follow certain rules and conditions to get started with, under close watch, of course, of the MAS, which has been, by the way, a very active proponent in the region in fostering digital securities itself. The SDAX claims that it's going to trade 16 hours a day and clear trades the same day using the Ethereum blockchain. So it'll be open to accredited investors and institutions to start. The operation is being led by Koo Boon Hoo, who was formerly commissioner of Singapore Police until 2010 and is a Temasek Foundation director. So it's also backed by Singapore's 6th largest law firm, which likely helps its legal and compliance bench. And it seems like yet another strong player has now entered into the security token industry in Singapore, Kyle.
That's so exciting.
And dare I say, Singapore is becoming the leader in global digital securities around the world, with Temasek also announcing last week that they're launching a joint venture with the Singapore National Exchange to launch MarketNode, which is another digital asset exchange. So they'll be working with Covalent Capital's bond issuance platform to initially focus on partnerships with several bond issuances to launch tokenized bonds on the MarketNode, and something numerous other firms have announced to focus on as well, including heavyweights HSBC. But seriously, that's 2 more projects that we didn't get to cover last week in our episode where we reviewed all the approved security token marketplaces and exchanges. So Singapore is already home to One Exchange, iStocks, HG Exchange, ECXX, DBS, and also partnership with SIX and the SBI to launch a Singapore exchange, and now among MarketNode and SDAX. So I probably missed 1 or 2 off the top of my head there too, Kyle. I mean, that's crazy awesome growth in the region.
We're going to have to really take some time and upgrade our exchange article, cover all these new platforms launching. This is exciting stuff. And Singapore, yet again, just moving with that momentum. They are fire hot right now.
Absolutely amazing. And next, we have another announcement from INX that their acquisition of security token marketplace Open Finance is almost complete, citing the only remaining step is approval from FINRA. So, and according to the Cointelegraph article by Colin Post, INX claims that they expect this to happen soon and that they will be live with their cryptocurrency and security token marketplaces within the next few months. So this, of course, would be huge news for INX and the industry as well. So we wait for this very public M&A process that's been playing out, as hopefully, I think since the middle of last year. So, and competitor Open Finance T0 also made some announcements. So first, the CEO Sam Norsalehi came out with his annual letter of progress, highlighting the 2020 performance, including increasing trading volume by 10x and adding 2 new assets, the Overstock dividend and the St. Regis to the platform. And of course, Sam also had to mention that T0 won the coveted Company of the Year award from the Security Token Show in the press release. So that's great. Not an easy accolade to earn, right? And furthermore, Sam highlighted their plans for this year, including one major announcement to start things off. If you didn't know, T0's parent company is actually owned or T-Zero's parent company is Overstock.com. So it means it's owned by that. And the furniture e-commerce company is definitely not related to blockchain. So you're probably wondering, how the heck did this happen? Well, Overstock actually launched a blockchain venture arm back in 2015, I think. And with some of its capital and among a portfolio of blockchain companies also came a spin-out company known as T-Zero. And the big news there is that parent company Overstock is actually partnering up with an outside portfolio management firm to transition oversight of Medici Ventures, including T-Zero. So that firm is called Pelion Venture Partners. Psalm says of the nature of the deal that, quote, the initiative will provide T-Zero with more strategic day-to-day attention, help them continue to scale, and further monetize the growth initiatives they have embarked on over the past year. He also confirms Overstock will also retain a direct, significant minority equity interest in T-Zero beyond its interest, of course, via Medici and the new arrangement. So furthermore, Psalm said that T-Zero itself is set to raise money this year and that the firm is already engaged an investment bank to help with this process. So there's no allusion to how much they're targeting. He also shared some other goals for the year, starting with a major integration with Prime Trust for this quarter for both the digital securities and crypto platform. That means that the custody of digital assets, including securities and cryptocurrencies, is supported now directly with Prime Trust, a major leader in the space. Additionally, the T-Zero ATS filed to support self-clearing for itself and its broker-dealer subsidiaries. And he also mentioned that the platform plans to onboard more strategic partners to help list assets on T-Zero, as well as support for third-party issuance platforms, which I think is actually a pretty big deal. So one example of this might actually be their recent announcement today, partnering with Family Office Networks, which has over 60,000 high net worth as part of its membership that can further be exposed now to T-Zero and its assets and maybe bring some into it. And finally, it's worth mentioning that Psalm did recognize the SEC's rejection of the Boston Security Token Exchange plans and that they're a part of, and acknowledge that they will continue to reapply for a national stock license. It seems that they're not deterred there at all. And so there's a lot going on for T-Zero this year. Could they become the go-to, the Coinbase of the security token industry in the U.S.? Kyle, they're the largest and most active market right now in the space. What is your take on all this?
There is a lot to break down in this announcement. First off, I want to congratulate the team and really commend them for being transparent in this process. I know that it's been very tumultuous for them in good and bad ways over the last couple of years. It's important to maintain this transparency to help us build and bridge the ecosystem. I love what they're trying to do from the infrastructure side, but I think that what really is the most fascinating piece for me is this T-Zero spinning out from underneath Overstock component. I mean, obviously the firm leveraged the Overstock brand to fundraise initially and to come to market, in addition to issuing that Overstock digital dividend, which was tremendous in bringing a significant amount of institutional activity to that platform, as well as a lot of that trading volume. We're going to cover that later in the episode. But I also wonder if there was some heightened regulatory scrutiny that may have come along with the fact that this ATS had a relationship with its publicly traded company that owned it, right? You'd think that being a publicly traded company, having to answer to shareholders, having an independent board, all this kind of stuff would have had an effect on a lot of these pieces. And so it's interesting to see, the flexibility that's going to come with this business now that they're going private. I mean, I remember that Sam had even mentioned in the 2020 roadmap last year that they had aimed to have 5 to 10 tokens listed by the end of 2020, and they were not able to make that happen. And so again, it's one of those questions of was it that regulatory component, and is that going to be eased now that they're kind of free on that front? So it's really exciting. And other than that, I love that they're looking to work on self-settlement. I think that's something that they're working with CompuShare right now, and they're trying to bring that in-house. There's a lot of cool things here. Can't wait to see what they do. Best of luck with the fundraise as well.
I think that's a fair critique, Kyle. I tend to agree with you. And good luck to T-Zero. Hopefully they make up for lost time here this year. And now moving on, we also had a newly launched into beta crowdfunding platform Akimona, which announced a partnership with security token-focused broker-dealer Tritarian Capital. So it's a powerful duo because now Akimona can launch Reg CF, Reg A, and help with Reg D and S through Tritarian, meaning that they can help you reach investors in any way you desire in the U.S. using their smart contracts-based platform. And under the partnership agreement, Akimona will provide technology for issuance of digital securities to Tritarian Capital as well. And on the Akimona technology platform, offerings under Reg D, S, and A will be conducted by Tritarian, and those under Reg CF will be administered by Akimona. So it sounds like a win-win in this partnership. Congratulations to both firms. And we also saw Vertalo make a partnership with a new player in the space by crowdfunding veteran and pioneer Woodniece, and it's called Guard with two Ds, which is a SaaS platform that collects, verifies, and disseminates private company information, including financial data, and facilitates transparency for investors, as well as blue sky compliance for issuers. So something that's necessary for most U.S. issuers launching a security token. The Vertalo partnership with Guard will enable issuers who work with Vertalo to avoid committing unintentional violations of these state securities laws. And I actually anticipate a lot of similar announcements and partnerships with Guard from other issuance platforms and crowdfunding platforms over the next few months, as this solution is definitely quite brilliant. It doesn't surprise me, though, since it came from such a contributor and expert in the equity crowdfunding space. Way to be one of the first on this, though, Vertalo. Congrats. And a big announcement from newly launched staking platform Tokens.com by Polymath founder Trevor Koverko proposed a reverse takeover to CoinHodl, which is listed on the Toronto Stock Exchange. So interestingly, Tokens.com is also noted to raise $15 million in a private placement offering as well. Quick progress for the company, given it launched not more than a month ago, and it's now already going public via this reverse takeover. And finally, we saw Arca announce two new hires to the team. The first is Vance Sanders, who will be the new CFO and Chief Compliance Officer, and Nikesh Dalal, who will be the new head of product for Arca Labs. So Vance's background comes with roles as CFO, COO, and treasurer at Equinox Financial Group, and Nikesh previously was a program director at Yield Street. Before that, he was at Consensus. So sounds like two great additions to the Arca team, which, if you didn't know, also launched the first publicly registered security token representing U.S. Treasury funds last year. And with all that great industry news out of the way, I want to end on some resources and opinion articles that came out, because there were a bunch of there that came out too. So the first to check out is week 3 of Peter Gaffney's Tokenize This series on Medium, where we now cover the more common business example of tokenizing a restaurant. So why do it? What are the benefits? And how could the security token be structured? This is what you can get insights on from Peter's fantastic article. And he continues to win major points in my book because he keeps using Miami examples. And this one's close to home because he used Kyle and I's go-to sandwich spot, La Sandwicherie.
Yes.
It's a French chain located throughout South Florida, so it's a very enjoyable read. Good stuff there. Looking out for the next one. Next, we have Dr. Amrit Kumar, who's the chief scientist at blockchain protocol Zilliqa, coming out and saying that mainstream finance is ripe for tokenization. He interviews Omar Fareed on Crowdfund Insider and gives you all his hot takes about why capital markets need blockchain. Obviously, many of those points are reiterated on this show, but it's always nice to hear from a PhD, right?
Yeah, for sure.
And the next article may not come from a PhD, but it does come from one of our own. That's Security Token Market's head of marketing, Jonah Schulman, who recently released an article telling us why we should say no to U.S. equities and yes to security tokens. So this was echoed on Omar actually on Crowdfund Insider as well. So the punchline, the same as Dr. Kumar's, which is that the current infrastructure for U.S. equities is outdated and archaic, and that we need to move towards blockchain yesterday.
Absolutely.
So we'll sum that up nicely with our main topic later today, I think. And an article on CoinDesk in the Money Reimagined series titled Narratives Wall Street Can't Control also echoes this theme. It's a nice long-form article by Michael J. Casey, the chief content officer at CoinDesk, and he walks us through the recent trends in crypto and how Wall Street is losing control over the loudspeaker of the finance world. So Reddit showed it can play this game. BTC is showing us that too, and the narrative won't be stopped. So definitely give this a read if you have 10 minutes. And if you ever thought about insurance and smart contracts, that is also an industry that will be reinvented, and security tokens can play a role too. There's a NASDAQ article describing how smart contracts create new paradigm shifts for policy management and settlement. So if you're curious about insurance and blockchain, definitely a good starting point with this one. And finally, something funny to end the news segment on here. An article on Decrypt came out addressing famous rapper Soulja Boy's Twitter cry for help to launch a token. So since it's 2021 and celebrities still want to launch tokens, the article went ahead and shared all the best practices and do's and don'ts for Soulja Boy to follow with Soulja Coin. And hey, if he wants to be a security token, we'd be happy to help him. Give us a shout, Soulja Boy.
Just don't follow in the shoes of Steven Seagal or the other ones that did it the wrong way.
Exactly.
Do it the right way.
We can help you do that. And that's the full rundown of the industry news from last week for you all amazing listeners. So, Kyle, do we have any industry webinars coming up to share?
Yeah, so in our webinars and events section this week, we do have one event. So a nice change of pace because the last couple weeks have been slow on that front. But this one's led by Polymath on February 23rd. And the webinar is an opportunity to hear from some of the top legal minds in the space as they discuss the challenges facing institutional adoption, token-friendly jurisdictions, and the technologies that can give lawyers the solutions they need to support compliant security token issuances. Featuring a panel of 3 blockchain and digital asset lawyers with global backgrounds and expertise, this will surely be a highly educational panel with insights you won't be able to find elsewhere. Check it out at 12 p.m. Eastern Time on February 23rd. You can register with the link in the description wherever you're listening. But unfortunately, that's the only event that we have this week. Remember, you can submit any industry news or events on stomarket.com/news, and we'll cover it on the show.
Well, Kyle, that means we can jump right into security token offerings and market updates. What do you got?
So our first security token offering this week comes from Sygnum Bank and Fine Wine Capital AG, who have successfully tokenized a range of premium wines, which are fully recognized under a new category of ledger-based securities in Swiss law. There weren't any details on specifics for the terms of those deals and what the wines are currently selling for, but according to the press release, they are now available for purchase for Sygnum users. On top of that, Alexandre Chaland, Fine Wine Capital's co-founder, noted that, quote, tokenization of wine assets enables us to expand our private collector investor base to new private and institutional investors interested in fractional ownership in distinctive real assets. This provides them the opportunity to hold, trade, or request a physical settlement of this unique asset in an efficient manner, end quote. And Alexandra just totally gets it. He totally understands the benefits of opening these opportunities for investors around the world, and we can't wait to see more about this deal as well as many others.
Totally.
Next up is US-based issuance platform Relio, who announced the launch of its Relio security token, the RST token. So this token provides investors with both equity and a shared revenue dividend from Relio's tokenized assets. The STO will be issued on their platform as a, get this, multi-chain asset, or MCA, which means that it will be available on the Algorand, Ethereum, and Stellar blockchains all at the same time. The same asset, 3 different blockchains. This token sale is available to accredited investors and non-US investors, and the firm has built a client pipeline already, as they also announced a joint venture with Valentus Capital Management to build a white label issuance platform called Valentus Digital, which also includes a $250 million credit fund. On top of that, Relio also announced a $100 million tokenized fund on low-cost Bitcoin mining through next generation cooling technologies, and a $10 million fund around administration engagement for a large residential tower project on Fifth Ave in New York City. So regarding the token sale, it also appears that the Algorand blockchain has made a pre-sale purchase of RST tokens to kick off the fundraise that was mentioned in the article. So Relio also has a utility token that it does use across the platform, which creates efficiencies in swapping assets and a lot of these different pieces. And that token is currently trading on Uniswap in addition to some other centralized exchanges. So I'd imagine a similar strategy will be used for liquidity once the RST security token hits those secondary markets. But there's no terms of the deal that we have available so far, but I will certainly update you on this one in the future.
Wow, that's some great stuff, Relio. And MCAs, multi-chain assets, that's definitely a main topic we'll have to talk about in the future. Great stuff.
Yeah, tune in for on Tuesdays. You'll get it. It's coming soon. Our final security token offering of the week comes from cryptocurrency payment platform Gilded, and the company has actually announced a very interesting structure for its security token offering, as the firm is launching a continuous security offering, or CSO, popularized by financing platform Fairmint. A CSO allows investors to make cash investments in exchange for security tokens over time instead of in a round-based financing situation, allowing the firm to continuously raise money over a given period of time and utilize that capital immediately instead of waiting for their entire round to close. If you want to hear more about continuous security offerings, you actually can check out the main topic of episode 30 of the Security Token Show, where you get the full breakdown. We discussed that in great detail. But regarding Gilded Security Token, which will go by the ticker GFI, I do have a few terms for the raise. The company is going to be raising $500,000 at a 5 mil valuation, so 10% equity, and there is going to be no voting rights on these shares, but they do have a liquidation preference on an exit event. Then we've got minimum investment of $500, which is open to international and U.S. accredited investors. So it looks like they're taking the right approach here, and I look forward to seeing the success of the raise. Best of luck to Gilded, and congrats to Fairmint for getting another client. We're very interested in seeing how the CSO structure continues to play out over time. And moving into the market update as well, we wanted to start off with the security token market end of the year report. So me and the security token market team put together and aggregated all of the information on the secondary trading market across 2020. And I thought it might be interesting to dig into that a little bit. So 2020 was a pretty incredible year for security tokens, as we've certainly covered here on the show plenty. After what would be described as a tumultuous 2019 for the secondary market, we finally saw investors begin to adopt these assets, and we saw an explosion of tokenization, with issued assets increasing 3x from last year and poised to increase exponentially here in 2021. So at this end of the year report, the research team here with me aggregated tens of thousands of transactions to track the market and provide an oracle for pricing data for investors, enthusiasts, and obviously for the memes. So let's dig into some of these stats, but you can also find any of these pricing information on stomarket.com. So the first thing to dig into is we've got our opening closing market cap for 2020. And so the opening market cap for 2020 was just a hair under 60 million US dollars. And that grew 517% up to 366 million to close out 2020. Trading volume followed an even larger increase, with the total trading volume in 2020 growing 1.1000%, 1100% to just under 70 million US dollars. So tremendous work for the industry this month. In terms of the best performing security tokens, we had T0 leading the pack, up 200% this year. Then followed closely behind with Overstock, up 195%. Then we had Audubon Road from Realty, up 53, plus that 10% dividend. And then you finally closed it out with Blockchain Capital, Curzio Equity Owners, and Spice VC to round out the top performing tokens. They all were 40 to 50% gains. And then the worst performing tokens in 2020, we had Lottery.com and Protos heading up that title. Lottery was down 80% this year. We've covered that in the past. That hasn't looked very good from a liquidity perspective, which I'm sure is taking on the price. Then to close out the worst performing tokens, we had IM Innovation, as well as Mount Pelerin and Startup Bootcamp to round that one out. The other interesting thing we looked at was the market cap growth since 2019. So we looked at some of those tokens that were live in 2019 to see how they've performed over 18 or 24 months as opposed to just 12 months. And so when we look at those 9 tokens, we had Blockchain Capital, we had Spice VC, 22X, Protos, Lottery, T0, and then 3 realty properties, Audubon, Marlowe, and Fullerton. And BCAP, Blockchain Capital, was flying up 130% since 2019, which is tremendous. Audubon was up 52%, and Marlowe was up 8%. But then the rest really struggled. Spice and Fullerton were down just single digits, so that's okay. But T0 is actually still down 60% from where it was when it originally listed, at least to close out the year. And then the real bottom here was Lottery. Lottery is down 96% from where it was at to start 2019. So not really great there. The biggest story here obviously is T0's decline. The market cap there is larger than all eight of those other tokens combined. But the shares listed and closed on that first day of trading, January 25th, 2019 at $8.75, and really haven't quite seen that since. Regardless, it's great to see the success of Blockchain Capital. We've talked about their portfolio in the past and really have made some good investments, including Coinbase, which is expecting to list here on the public markets in 2021. And they've done tremendous, as well as tokenized real estate, which has performed well. And again, they have a nice dividend return. So if you factor in the dividend return, all 3 of the real estate properties since 2019 have been positive. Then to close it out, we have our top exchanges and marketplaces. We've got 1, 2, 3. First place, shouldn't come as a surprise, is T0 with a market cap of 276 million and volume of 52 million. Merge Exchange comes in second place with 37 million in market cap and 40,000 in volume. And then Open Finance closes it out in third with a market cap right under 30 million and a volume of 153,000. So while some of these exchanges are doing well, T0 as a marketplace is certainly leading the pack, both in terms of market cap and just tremendously larger volume than what we're seeing anywhere else. And then moving into this week's performance, so just from the end of January into the beginning of February, the market has pumped for what feels like the first time in forever. On the heels of this T0 announcement we covered earlier in the show, both shares of Overstock and T0 saw significant gains this week. Overstock shares were up 31% and T0 shares were up 23%, which brought the entire industry market cap up 24% to $520 million US dollars. And so not only were the shares up up significantly, but we saw some serious trade volume this week. Overstock's tokenized shares actually saw about 2.8 million in trading volume just on Wednesday alone, bringing the total weekly volume for Overstock over 5 million US dollars, which is crazy. Even crazier when you think about the fact that the tokenized Overstock shares have zero trading fees, so none of the activity contributes to the T0 token value, but that's besides the point. T0 has also been pumping as it now approaches the $5 range for the first time since November 2020. It seems to be building some positive momentum, so it does make me wonder if these shares will make a run for that all-time high mark of 875, which the shares hit on the first day of trading back in 2019 and haven't hit since. There really wasn't much other action to report this week because oddly, many of the realty tokens had exactly zero volume over this week, which is actually something that I really can't remember happening in any other week that we've been really monitoring the market. It always seems like they do some volume that I can report on. Unfortunately, not this week. So not much volume there, but the prices did hold steady, which does suggest that the liquidity pools are still healthy and it's not a price decline based off of low trading volume.
Well, Kyle, thank you for yet another thorough market activity report, and great job, team, on doing the whole annual report there. Very interesting insights and facts. Hopefully you listeners felt the same way. Do let us know your comments and feedback on Twitter and all our communities. And it does look like T0 is getting very busy again, Kyle. That's only a good thing.
Yeah, you're not kidding. I mean, I think they've done almost 6 million in trading volume in this week, which again, we only had 60 million in all of 2020. So really says a lot about how the ATS has been performing. But unless we have anything else to add, I think it's ready to dive into this juicy main topic for the episode, Herwig.
I'm fully on board with that idea. You know, we've been hinting at it all episode. So GameStop has unveiled many of Wall Street's complexities and flaws. And as I mentioned, they won my company of the week because savvy players like Chamath are realizing that a blockchain is absolutely the answer to fixing and improving Wall Street as we know it. So public markets need security tokens, folks.
Absolutely. You know, no article sums it up better than the Fortune magazine article by Graham Moore, who is the head of tokenization at Polymath. But we're also going to break it down now here on the show. So let's dig right into it. And I think it's important that we start with the backstory that in the 1970s, which is when the NASDAQ launched, which ushered in the era of electronic trading. During that same time, the SWIFT network was also invented. And so despite some nominal improvements in that technology, public markets and financial systems still operate on this largely outdated technology. Now, despite the infrastructure changing, it really hasn't stopped other innovations from happening, like app-supported brokerages like Robinhood and the introduction of features like zero commission trading and leveraged trading for retail investors.
Yeah, so essentially new ways to bring investors into the Wall Street ecosystem, but no changes to the actual Wall Street infrastructure.
That's exactly right. So what we saw last week with GameStop was these innovations catching up to the old guard of Wall Street, showing the kinks in the armor. Now, like Graham's article, we see a future where security tokens disrupt a lot of Wall Street as we know it, but for now, we'll keep the conversation towards improving Wall Street, not just destroying it.
Right. So I think the best place to start there is Chamath's commentary on the All In podcast that he was featured on. He mentions a few solutions to all this. We can, add our opinions and expand from there, Kyle.
Yeah, I think that sounds good to me. How about you break it down for us? What did Chamath argue?
Well, the first thing Chamath did was we talk about the benefits of reconciliation and knowing who all the beneficial owners of a stock are, giving the example that you can't borrow on a share if you can't instantly prove that you own it, and pointing to the issue with GameStop at one point having a short position that is 136% bigger than the company itself. So this is exactly why he said it's the first obvious use case for blockchain, because by design, blockchain is a decentralized ledger showing who all the beneficial owners are.
Yeah, this whole thing is absolutely ridiculous. I mean, the idea that over 100% of outstanding shares could be shorted revolves around a concept that is actually something that is technically illegal, called naked short selling. Essentially, a naked short sale is a consequence of manual share management where short positions can be opened without actually registering a borrowed share to short. While naked short selling is illegal in the market for investors, it does not appear to be illegal for market makers, which is incredibly crooked and, in my opinion, is fraudulent. With a blockchain-based or blockchain-managed ledger, you can programmatically assign collateral and create a much higher level of accountability for outstanding shares. In a tokenized market, a short position literally could not be created without a smart contract requiring a deposit of that borrowed share. In this way, we could see exactly which shares are being borrowed or lended out, preventing what is essentially a double spend that we've seen by market makers, where they can lend out their share on the short markets multiple times. This causes huge issues when the positions need to be closed and those borrowed shares need to be returned, as there's literally not enough outstanding shares to actually fill those short positions, which leads to this absurd squeeze and price rise we've seen on some of these assets where everybody's caught with their pants down.
Absolutely right, Kyle. I couldn't have said that better myself. We can't have stocks be lent down more than once. That's crazy. And it ties into what Chamath said next. The other example has also that he mentioned as a solution is the need for more disclosure. So he says everyone should be forced to disclose what they own on a weekly basis so that regulators and watchdogs can comb through it. So this, of course, could be a nightmare scenario for large funds and not necessarily scalable, unless, of course, portfolios were completely managed with security tokens so that publishing the current holdings to regulators wouldn't even require a button to be clicked.
Yeah, this is also a very interesting point that he makes. If our listeners, if you're not aware, hedge funds with over $100 million in assets must disclose their holdings. I think it's approximately 45 days after the end of each quarter, and they got to file that to the SEC. However, it's kind of weird because they're not required to publish their short positions. They only need to disclose their longs. And so I guess this is to try to protect those funds from being taken advantage of through squeezes and over-leveraged shorts and stuff like that. But I still think that this should be revised, especially with blockchain-based ledgers that can assist with these disclosures, as they could be programmatically generated, as you mentioned, Herwig, and that kind of removes a lot of the scalability concerns that a manual process would require. But something's got to change there, I think.
Oh, completely, man. So next, we can look at Graham's article on Fortune, right? He points out that if stocks were tokenized, investors would have stronger controls because they could self-custody them and move them between brokerages that are able to meet their needs, in case Robinhood wasn't able to. So in this way, investors would be protected because they wouldn't suffer from being shut out of trading for having chosen Robinhood as their brokerage account. You can imagine that with the blockchain, it's easy to move custody around while retaining that beneficial ownership record and implementing those controls that we're talking about. So all these things are the SEC, something that they should be thrilled about, I think.
On top of that, margin and liquidity requirements could be programmatically set by the SEC and specifically the NSCC, which is the organization that does set those requirements for brokerages and the fees associated, that would prevent the variability that we've seen in the derivative markets. So in this way, as hinted by Robinhood CEO Vlad Tenev in a Clubhouse conversation a couple days ago, brokerage firms would not be exposed to as much volatility in the margin requirements, which are set by those outstanding liabilities. Because this is really what happened with Robinhood, is that they went insolvent because they were unable to predict the fees that were associated with their outstanding derivative positions. And so by setting up these graduated programmatic fee structures, brokerage firms could understand their reserve requirements and could much better plan for these fees instead of being surprised by them like we saw last week, which really can lead to insolvency across multiple platforms and causing a small collapse in assets. And fortunately, they were able to raise that money and solve this problem quickly because it doesn't take too many days of insolvency before you start having bank runs and some real structural problems.
Oh, yeah, totally. That's a great point. And I also think there are some other crazy instruments that can be made up too, right? A staking program, for example, to help incentivize holding on to GameStop that can be created, encouraging stockholders to lock their trading for their shares. Yeah. Markets could also react in real time without being affected with multiple day lags, in settling the stock, which is having huge effects on the market price. The list of efficiencies can go on and on, not to even mention, all the cost savings, of course, that would be applied across the board. So were there any other ideas you wanted to mention in regards to all this, Kyle?
Yeah, I really think programmatic settlement is that final point that gets me excited. Market makers have so much control and leverage over the brokerage platforms and really the market as a whole. And this is something that we're seeing disrupted on the DeFi scene through automated market making solutions pioneered by Uniswap, Balancer, and those other decentralized exchanges. But you combine that with 24/7 markets that security tokens provide and immediate settlement where we don't have to wait multiple days and have some of these issues that come with multiple derivative synthetics because of the fact that there's too long of a settlement time. So I really think that with optimizing these processes, we can really create a healthier, more transparent market, which in the long run does improve liquidity, it improves price discovery, and improves international access into these markets, which are all things that we really need to optimize for. And these things take time, but here we see yet another opportunity for improving capital markets, and I'll tell you what, I'm here for it.
Same here, Kyle. Same here. The future of public markets look a whole lot brighter with blockchain. And that's all that we have for you today, folks. So thanks so much for tuning in to episode 79. Reach out to us on Twitter or LinkedIn if you have any articles to share, questions to ask, or feedback to submit to us. Otherwise, you can always join the community at stomarket.com/news, or you can even join our newsletter at newsletter.stomarket.com.
Catch you all next week. Thanks for listening.